If you start looking into company financials, you quickly realize there are dozens of different ratios out there. Price to earnings ratio, current ratios, debt to equity ratio, return on equity, asset turnover, the list goes on and on. Choosing random ratios without a clear process or structure will not give you the most optimum results. If you jump from a valuation metric to a profitability metric and then randomly check liquidity, you end up with a confusing scattershot approach. So, how do you actually make sense of them all? The key is to stop picking ratios at random and adopt a risk first filtering approach. A risk first filtering approach is a decision making method where you eliminate options based on risk before evaluating potential returns, benefits, or opportunities. Instead of asking which option can make me the most money, you first ask which options can hurt me the least or can create unacceptable risk. Only after risky options are removed do you compare the remaining choices. In 1934, right at the devastation of the Great Depression, two Columbia University professors named Benjamin Graham and David Dodd published a monumental textbook called Security Analysis. Before their book, Wall Street was essentially a chaotic casino driven by a speculative hype and raw emotion. Graham and Dodd changed everything by establishing a rule that defined modern investing. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Around the exact same era, corporate pioneers like Donaldson Brown at the DuPont Corporation were developing structured financial models. They realized that managers and lenders couldn't just look at random profits. They needed a systematic cause and effect hierarchy to evaluate business health. Lenders in particular didn't care about getting rich, they cared about protecting their capital. They forced companies through strict survival filters before even handing over a dime. Today, institutional investors, credit rating agencies, and elite portfolio managers still use this exact multi-stage screening process. And in this series, we are going to break it down into the 5-gate funnel. Think of analyzing a company like going through airport security, where you have to pass mandatory checkpoints one by one. If a company fails an early gate, you throw the stock out immediately, no exceptions. We begin at gate 1 with short-term survival using liquidity ratios. When we look for investment, our primary fear is whether the company will survive to see appreciation in prices. Cash is oxygen. So this gate uses metric like the current ratio and the quick ratio, also known as the acid test ratio, to ask if they can pay the bills due this month. If a company's cash reserves hit zero next week, its brilliant long-term growth strategy doesn't matter because it's simply dead. Once short-term survival is cleared, we move to gate 2 for long-term survival using solvency ratios and leverage ratios. Here, our next fear is whether the company will survive a multi-year economic winter or a recession to see a long-time price appreciation, making sure they are not drowning in debt or going to get crushed by heavy interest payments down the road through metrics like debt to equity ratio, the debt to asset ratio, and the interest coverage ratio. Only after we know it won't crash do we arrive at gate 3 to evaluate the business engine using profitability ratios. Now that we are confident the company can survive, our next focus is whether it is actually a good business model that will survive with strong enough earnings and profit margins to reward our investment. Measured by tools like the gross profit margin, operating profit margin, net profit margin, return on equity, and return on assets. From there, we pass to gate 4 to look at execution using efficiency ratios, also called activity ratios, determining how well management is operating the machinery and sustaining those earnings by tracking how fast inventory moves and cash is collected through metrics like the inventory turnover ratio, accounts receivable turnover ratio, and asset turnover ratio. Finally, we reach gate 5 for the price tag using valuation ratios to answer if the stock is cheap or a rip-off based on indicators like the price to earning ratio, price to book ratio, dividend yield, and enterprise value to earnings before interest, taxes, depreciation, and amortization. Over the rest of the series, we are going to tear open real financial statements and walk through these 5 gates one by one. You won't just memorize confusing formulas, you'll learn how to build an institutional grade filter to protect your hard earned money. Next week, we drop into Gate 1 liquidity. We'll look at how companies with millions on paper still go broke because of poor timing. Make sure you hit subscribe so you don't miss this. See you next time.